Do you feel like you are losing your mind? You wake up, check your phone, and the financial news tells you everything is amazing. The S&P 500 is breaking records, GDP is up, the soft landing is here. Then you go to the grocery store, and a bag of chips costs $8. You talk to your friends, and they are terrified of getting laid off. You look at housing, and it's mathematically impossible. You feel like you are living in two parallel universes. In Universe A, the one on the charts, we are in a booming golden age. In Universe B, the one in your wallet, we are in a silent depression. If you feel like you are being gaslighted, I have good news. You are not crazy. You are witnessing a rare historical phenomenon called the Great Disconnect. To the casual observer, it looks like resilience. It looks like the system is bulletproof. But to a forensic analyst, it looks like a crime scene. The dashboard of the global economy is broken. The speedometer says we are going 100 miles per hour, but the engine is on fire. We are living through a fundamental regime shift. We are moving from an era where central banks controlled the game to an era where debt controls the game. This creates a paradox, a world where the economy can rot from the inside while asset prices melt up to the moon. In this Season 2 premiere, we are going to open the hood. We aren't going to look at the headlines, we are going to look at the plumbing. We will explain why the stock market has stopped measuring growth and started measuring fear. Welcome to the Great Disconnect. Let's start with the biggest lie on your screen, the stock market. When you see the S&P 500 hitting all-time highs, you assume American business is booming. You assume the average company is killing it. That is a valuation mirage. Forensic data shows that the market is currently trading at a price-to-earnings ratio of nearly 28x. That is expensive. Historically, you only pay that much when rates are low and growth is exploding. But right now, rates are high and growth is slowing. So who is paying these prices? The answer is nobody is buying the market. They are buying a bunker. This isn't a broad rally. It is a crowding event. Just 7 companies, Apple, Microsoft, Nvidia, Google, Amazon, Meta, and Tesla, now account for nearly 34% of the entire index. These are the Magnificent Seven. If you strip them away and look at the S&P 493, the other 98% of companies, you don't see a boom, you see a recession. The average stock is struggling. The average company is suffocating under high interest rates. So why is everyone piling into these 7 names? Because they have become the new Treasury bonds. These companies are cash rich. They don't need to borrow money, so high interest rates don't hurt them. In fact, they earn interest on their cash piles. Investors are terrified of the real economy. They are terrified of the government debt. So they are running into the only lifeboat that looks unsinkable: big tech monopolies. This concentration creates a single point of failure. The market has the narrowest breadth in 35 years. It's like a skyscraper supported by only one pillar. As long as that pillar, AI narrative, holds, the building stands. If that pillar cracks, gravity takes over. This is not a bull market. This is a panic room with a nice view.
So, we have a top-heavy market. But what is driving the money? Why is liquidity rising when the Fed says they are tightening? To understand this, you have to realize we are no longer in the economy of the 2010s. We have entered a Chimera regime. A chimera is a hybrid monster. Our current economy is a mutant combination of two distinct historical disasters: the debt of the 1940s, the inflation of the 1970s. Usually, you only get one. We won the lottery and got both. U.S. debt is over 124% of GDP. That's World War II levels. But inflation is sticky and volatile, like the 1970s. This creates a fiscal dominance trap. Here is how the trap works, and I want you to visualize a car. The Federal Reserve is driving the car. They're slamming the brake, quantitative tightening, to stop inflation. But the U.S. Treasury is in the passenger seat, reaching over and slamming the gas, fiscal deficits, to keep the government running. The Treasury is running a $1.9 trillion deficit. That's 6.2% of GDP in peacetime. That's historically insane. To fund this, they have to flood the world with debt. This creates a liquidity paradox. The Fed tries to pull money out, the government pours money in. The result? The car doesn't slow down, the engine just overheats. The money from the deficit spending flows into corporate profits and asset prices, keeping the stock market high even as the interest rates try to crush it. This is why bad news for the economy, like high deficits, becomes good news for stocks, because the market knows the government cannot stop spending. They are essentially printing money to pay the interest on the credit card. The system has shifted from monetary dominance, Fed controls the game, to fiscal dominance, debt controls the game. And in fiscal dominance, cash is trash and assets are king.
Now, let's go deeper. Let's look at the plumbing that nobody talks about until it bursts. The scariest part of this rally isn't the valuation, it's the leverage. There is a ticking time bomb under the floorboards called the basis trade. Now, you might ask, wait, hedge funds are shorting the future? Does that mean they think the market will crash? No. They don't care if the market goes up, down, or sideways. They are playing a game called arbitrage. Here is the mechanic. Right now, due to a quirk in the system, a Treasury futures contract is trading slightly more expensive than the actual Treasury bond. So these funds do two things at once. One, they buy the cheap bond. Two, they sell the expensive future. By doing this, they lock in that tiny price difference as profit. It's free money. It's a guaranteed win. But there's a catch. The profit is microscopic. We're talking pennies. To make it worth their time, they can't just use their own money. They have to use massive leverage. We're talking 50x leverage. Think of it like picking up pennies in front of a steamroller. If you pick up enough pennies, you get rich, but you're doing it with borrowed money. Right now, there is $1.85 trillion of this leveraged bet sitting in the Cayman Islands. And here's the danger. They borrow this money from the repo market. They're pledging the bonds they bought as collateral to get cash to buy more bonds. It's a house of cards. If interest rates spike even a little bit, or if the banks get scared and stop lending, the trade stops being profitable instantly. They get a margin call. They're forced to sell the bonds immediately to pay back the loan. When you force sell $1.85 trillion of bonds, yields scream higher, stocks crash, and the plumbing explodes. And remember the car with the brakes on? The liquidity buffer that usually saves us, the reverse repo facility, RRP, is empty. It has drained to near zero. We have lost our shock absorber. Going forward, every dollar the government borrows comes directly out of bank reserves. When bank reserves get too low, the repo market breaks. This is why the market feels so jittery. We're driving at maximum speed, picking up pennies on the track, and we just realized the airbag has been removed.
So what do? The economy is broken, the debt is unpayable, the plumbing is leaking, but the stock market is at all-time highs. Do you sell everything and hide? If you did that in 2023, you missed one of the biggest rallies in history. This is the torture of the melt-up. In a fiscal dominance regime, the currency is being debased so fast that asset prices rise nominally even if the real economy is sick. It's not a bull market, it's a crack-up boom. The forensic evidence suggests a barbell strategy. 1. Avoid the middle. Medium-risk bonds, average stocks, and zombie companies are the kill zone. They get crushed by high rates. 2. Own the insurance, the safety, gold. Gold has already divorced from interest rates. It is sniffing out the debt crisis. It is the anti-Treasury. 3. Own the scarcity, the risk. The market is crowding into assets that have monopoly power and cash. That is currently big tech. But most importantly, you need a radar. You need to watch the signals that tell you when the plumbing is about to break. 1. The Psalm rule. Watch unemployment. If it ticks up 0.5%, the recession is official. 2. Reverse repo. Watch it hit zero. That's when the liquidity buffer dies. 3. The yen. Watch Japan. If they sell US bonds, yields spike. We are not here to tell you to buy or sell. We are here to tell you that the rules have changed. The disconnect isn't a glitch. It's the new operating system. And in this system, you don't get rewarded for optimism. You get rewarded for positioning. In the next episode, we are going to talk about the invisible tax that is funding this entire illusion. We are going to talk about the gaslight and why the inflation numbers you see on TV have nothing to do with the life you are living.